Okay, I think we're going to get started here today on this webinar on driver per diem and wage recharacterization. My name is Dave Hatch, and I want to thank everybody out there for joining us today. I know a lot of you may or may not know us over here at HCH. Just to give those of you who may not know a little bit about HCH a little background on who we are and what we're all about. We are a consultant in the transportation industry. We only work in the trucking industry. That's all we do. We work for fleets of all sizes, from 100 to 10,000 carriers, and with 25 plus years of experience, not only in driver per diem, but also in a number of other areas, including licensing, registration, titling, fuel refunds, a number of areas like that. And per diem is just an area that's very near and dear to us, just because we've been doing it from the beginning of our company. So we focus a lot on per diem, and so have been hosting some webinars on per diem. This is a continuation of a previous webinar we had. I know some of you may have joined us for that previous webinar on the do's and don'ts of driver per diem. And during that webinar, we went over a lot of the things you should do when implementing a driver per diem program, and the red flags you should look out for. And one of the main questions that kept coming up during that webinar was we kept having a lot of questions on wage recharacterization. A lot of carriers kept bringing up concerns of how their program was being run and whether that was wage recharacterization. So we thought it would be a good idea to help educate not only current clients who work with us, with HCH, who know us on wage recharacterization, but also any other carriers out there who might have some questions on what that really means to have a non-compliant per diem program in regards to wage recharacterization. So that's why we're having this webinar today. We'll have many more in the future. If anyone's interested in viewing that previous webinar on the do's and don'ts of driver per diem, feel free to reach out to myself. We'll have some contact information at the end here that you can reach out to me. Let me know. We'll send you a link so you can watch that as well. Housekeeping items to go over is we're going to answer some questions here at the end. Have a quick Q&A session at the end there that we can answer any questions somebody might have. We'll try to answer as many as we can. We're going to hold most of those to the end. If those of you who are familiar with Zoom, you'll see the Q&A icon there in the bottom of your screen. Feel free to type in a question you might have anytime during the webinar, and we'll try to address those at the end. But to get started, I guess what I'm gonna do is turn the time over to Tommy Dean here. He's gonna be our main presenter. Just a little background on Tommy. Tommy is a in-house counsel over here at HCH Transportation Advisors. Tommy has a main focus on driver per diem. He deals in driver per diem on a daily basis, knows the ins and outs, the case law, basically the regulations that dictate how driver per diem needs to be run. And with that, I guess I will turn the time over to Tommy.
Thanks, Dave. We just wanted to make sure before we get started that everyone on the webinar understands that we can't give legal and tax advice over the webinar. That's not why we intended this. This is for informational purposes only, because you're going to find out real soon that administering a per diem program is a really, really fact-specific process. So we couldn't possibly answer all the questions that about your plan over the short period of time. With that said, I would caution you on the question and answer box not to submit anything you wouldn't want us to share as an example if we're going to do a question and answer at the end of the program, so that we're not unintentionally disclosing information that you might not want others on the webinar to know, or future people that are viewing this webinar later. And so we just wanted to be upfront that that's where we're headed today with everybody here. And with that, I think I'll get started. I guess a good place to start, obviously, is in the beginning. And the basic requirements of per diem are set out by a regulation, and that's Regulation 62. And it reminds us that per diem is a creature of statute. That per diem has certain requirements that you're going to have to meet, and those requirements are set out in the same regulation that is authorized by the statute. This was all set out in 1989, and those include business connection. You have to substantiate your expenses. You got to deal with the return of the excess per diem. All this has to be done within a reasonable period of time, and you have this fifth caveat that really gets ballooned out there, and that is making sure your plan is not abusive. And we showed these slides because today we want to let everyone know that we're talking today about wage recharacterization. And wage recharacterization is one part of the requirements. It's part of the business connection requirement. So we want to just make sure that everyone here understands that just because you avoid wage recharacterization doesn't necessarily mean that your plan is accountable. You also have to deal with substantiating the expenses. You also have to deal with return of the excess and all the other requirements under the statutes, regulations, case law, etc. And vice versa. Just because you deal with the substantiation, maybe you have a really creative way of dealing with return of the excess, doesn't necessarily mean that you have avoided wage recharacterization, and it doesn't necessarily mean that your plan is accountable. So these are all requirements of the statute, and they're all independently required from the Regulation 62. So we just wanted to be clear that we're talking about avoiding wage recharacterization, as Dave mentioned, because it was the most popular question on our last webinar, and we thought we could do the most good for carriers by discussing it in more detail. So it helps in the beginning to sort of have a layman's definition of what wage recharacterization is. And in short, we're going to be working from this sort of idea the whole time. And that's, wage recharacterization is really arranging to pay an employee the same amount, wage plus per diem, regardless of whether they incur per diem expenses. Or another way to put that is, in our industry, is regardless of whether or not they're out overnight. So if it looks like we're just trying to pay an employee a set amount, regardless of whether they're out overnight, the IRS is going to conclude that that's wage recharacterization. The case law is going to conclude it's wage recharacterization, and you're going to be deemed non-accountable. You'll fail the business connection. Obviously, that's the one we're talking about. It's a non-accountable plan. Your per diem will become taxed. And that tax is a hard hit because it's 15.3% of all the per diem that's paid. That's the FICA for the carrier and the driver. So it's not just your FICA. It's not just a 765 that you pay. The carrier will have to pony up the additional FICA for the driver too. And then obviously the IRS is a fan of penalties and interest. So we know that those are going to apply as well. So because per diem is set out this way, it makes it really good in the wage recharacterization sense to talk about examples, because that's the way the IRS gives it. So today we're going to talk about 4 bad examples and 1 good example from the regulations and the case law. They call them situations usually in the regulations. And today we're going to show you, kind of reveal the curtain a little bit. How would HCH determine whether or not a plan was engaging in wage recharacterization, and does it apply, and all those things? But we want you to follow the money, because the reality is you guys can engage in a lot of different ways of paying your drivers, but ultimately you need to ask yourself, how is it? What are the facts showing me about how I'm paying my driver, and how does that stack up against the case law? So that's the approach that we take here, and that's the approach we're going to take today. Again, we're going to go through these 5 examples. We have about 20 to 25 minutes worth of material, so not too long of a webinar, and then we'll get into question and answers. So our first example, which is a bad example, an example of what you don't want to do, comes straight from the very first regulation. That's Regulation 62. That's example J1, the very first example from the very first regulation from back in 1989. It's the engineering example. And we'll talk about this same sort of scenario over and over again. You'll see it throughout the webinar. And in this example, the engineering firm, they want to pay their engineers $200 per day. Now they understand that sometimes their engineers are out overnight and sometimes they're not out overnight, just depending on where the work site is. And so what they want to do, the engineering firm wants to do in this example, is while the driver is away from home, we're going to take that $200 per day and we're going to pay them $150 in wage, and we're going to pay them $50 in per diem. And that's going to make up their total compensation that we owe them. Now, if all of our engineers were out every single day, all the time, and there were no exceptions to that rule, this might be actually okay, provided you meet the other requirements of the statute, obviously. But however, in this example, we know that's not the case. So whenever the engineer is near home, we're going to pay that engineer $200 in wage and $0 in per diem. So basically, what's happening is we're waiting till the end of the pay period. We're determining whether the engineer was away or not, and then we're paying them the per diem, so that the wage is changing after the fact. The IRS straight up front, very first example, very first regulation says this fails the business connection rule. This is a non-accountable plan. And why? Well, the IRS specifically says the employer would pay an engineer $200 a day, regardless of whether the engineer was traveling away from home. So regardless of whether or not they had expenses, their goal was to just pay the engineer $200 per day. And that looks like that, informal definition of wage recharacterization we just talked about. Now you're going to notice in these bullet points that we have up here, this is the money that we're going to follow throughout all of the examples. And so classic IRS, they start out with not telling us what we should do, but instead telling us, okay, well, whatever you do, don't do this. If you put your per diem plan through the matrix and it comes out looking like this, you're in trouble. And so we start early on, after the most recent large tax code changes in 1989 with this example. Now, in that same sort of regard, we go a while and the IRS says, you know what, just in case you weren't careful, we're going to go on to the second example. And this is situation 2 from the IRS Revenue Ruling 2004-1. Over the years between 1989 and 2004, there was some case law that came out. There were some situations the IRS saw happening with taxpayers. And so they come out with a revenue ruling just in case we didn't understand what they didn't want us to do. And this is the situation 2. And this is, probably the second good situation that we have. And in this case, we have drivers, which automatically should perk up the ears of everybody on the call, because obviously we have drivers. So we know that the IRS is saying something to us in this particular revenue ruling. And in this case, the drivers were being paid a percentage of a tag rate or the delivery rate. And for purposes of our example today, we're going to set that at 40%. And you'll see why in just a second. And what Revenue Ruling 2004-1, situation 2, by the way, this is a bad example. You don't want to do this. Again, IRS is telling us another way of not to run our program. Is we'll assume that while the driver's away from home, let's say they had $500 worth of tag rates. And at 40%, that's obviously $200, so that our math can normalize between the earlier example. And when they're away from home, for whatever reason, we're going to pay them $150 in wage, and we're going to pay them $50 in per diem. So we're going to take part of that compensation, we're going to shift it over, we're going to characterize it over as per diem, and we're going to leave the rest of it as wage. And that will pay the driver the $200 we agreed to pay him, the 40% of the tag rate. Now, when the driver is near home, we realize that he doesn't have per diem expenses, so we can't get away with paying him per diem. But we've agreed to pay him the $200, right, the 40% of the tag rate. Well, in that case, under this example, the situation 2 of 2004-1, we're going to pay him $200 in wage and $0 in per diem, and that's going to be the same $200 compensation. We've highlighted the areas we want you to follow through these examples now. And you can see, you remember from the earlier example 1, this is basically the exact same example. So the IRS is sort of repeating itself here, and it's saying, I don't care if they're drivers. I don't care if it's a percentage versus a straight fee or an hourly fee. How you actually, how you pay the driver is not important for the wage recharacterization issues. What's important is, what's the effect? How is it that you're paying the driver? And of course, here we can all anticipate what happens. The IRS rules, no, this fails the business connection rule. This is not an accountable plan. And you can easily see why that this example is not going to work in IRS's mind. And that brings us right into the third example we're gonna cover real quickly. And the third example is actually a case, and this was a shotgun case. You can tell really quickly that the previous 2004-1, that revenue ruling, was a response to the shotgun case. Now, the shotgun case is a little bit different, and maybe even a little bit more dastardly from the carrier side of things. Again, you have drivers, so you have a similar situation as to what anyone on the call would see today. Here you have, they call it a percentage of the delivery charge, basically the same thing, and that percentage really was 40% in this case. But what the carrier was doing here is they were taking the total compensation and then they were adjusting the wage portion of that to just meet minimum wage. So here's what it looked like. Let's say you had a $500 delivery charge. We're going to normalize it to meet our examples. And at 40%, that's the same $200. And this driver here, maybe he was a pretty good driver. And so, he didn't have so many hours to meet minimum wage. With just the wage portion, we're going to have to pay that driver $100. And that's all. We don't have to pay him $101. We don't have to pay $100. So we're going to pay him $100 in minimum wage. And that's going to be the wage portion. And we have some left over that we still owe the driver. We have enough expenses to go around. So we're going to make the entire rest of that amount in per diem or an expense reimbursement. And that's going to be his total $200 compensation. But let's say that you got to take the same driver and maybe traffic was heavy one day. He's making the same $500 in delivery charge at the same 40% at $200 and with roughly the same number of stops or what have you. But in this case, maybe he's just not able to do it as efficiently. Maybe it takes longer. And so in that case, we say, well, that driver, we have to pay him $150 to meet minimum wage instead of the $100. So that only leaves us $50 left in per diem. And so you can kind of tell what the carrier is doing here. They're adjusting the wage after the fact, depending, upon whether or not they can meet the minimum wage with it. Clearly, the court sees right through this. We kind of can expect what's going to happen here. This fails the business connection rule. The court rules this is a non-accountable plan. Obviously, that's a bad outcome. We don't want to. What is another example of what we don't want to do? The court says our goal here is to prevent companies from improperly sheltering otherwise taxable compensation. That's a really lawyerly way of saying this prevents companies from committing wage recharacterization, from just saying, well, what we really wanted to do here was pay the minimum amount of taxable wages possible. This is sort of a no-brainer example. This is something like, well, yeah, of course, because that's the whole point of the plan was to reduce the wage down to the absolute minimum that we needed. And of course, this is the per diem is not attached, or the expense reimbursement was not attached to any sort of expenses here. It was really just attached to how many hours the driver had put in. And so shotgun comes down, and should not be a real big surprise when you look at the facts and you follow the money in this case, that hey, we're changing wage after the fact, we're paying drivers that shouldn't be paid, this is what's going to happen in that sort of instant. And that brings us really to the most recent bad example. Again, this is from a revenue ruling. This is IRS Revenue Ruling 2012-25. When this revenue ruling came out, there was a lot of discussion about it. But the reality of this first situation, which is situation 2, it's a nurse situation, is when you look at the effect, this is really just a rehashing of what we've already seen. This is another good example of what not to do. In this case, we have nurses. They're paid a salary. So the IRS is going the ropes here. They're saying it doesn't matter if you pay them salary. It doesn't matter if you pay them percentage. It doesn't matter if you pay them hourly. It doesn't matter if you pay them by the day. Those sort of characteristics are just not going to matter. If you adjust the wage with travel, this is what it looks like. Obviously, we've seen this example before. When they're away from home, we're paying them per diem. When they're near home, we're not. But roughly, we're paying them the same compensation either way. And the IRS comes to, should be pretty obvious by now for everyone on the webinar. This fails the business connection rule. This is ruled as a non-accountable plan in the revenue ruling. Now, and this will take a second to explain. We have another situation in 2012-25 that is perhaps more interesting. And this is situation 4. For those of you who've been keeping track, this is going to be our 5th example. We've done the 4 bad examples. You can see kind of why it would be. You can see the rubric that we're working with now, the highlighted areas of you have to determine, well, what's actually happening with my plan. And this is going to be our last stop. Now, this is the mother lode, because this is going to show you, okay, if you want to run an accountable plan, the IRS says, all right, we'll show you how to do it. And this is situation 4. And in situation 4, we have cleaning services. And we need to set this up first. What the cleaning service is going to do, they're going to hire, obviously, employees to go out and clean businesses and houses and establishments. And they want to pay their employees an hourly wage. Now, they know that the employees are going to have expenses, because they expect the employees to cover those cleaning expenses, and then they're just going to pay them enough that it's going to cover those. And so they go about their business, and then they decide midstream they want to stop paying them that way, because they're paying them taxable wage. And obviously, there's a more efficient way of doing that. They decide that they're going to start paying part of those wages in per diem, or part of those wages in an expense reimbursement. And they're going to it's called prospectively adjusting the wage. And instead of paying, say, a cleaner $200 per day just straight wage, they're instead going to do this. Let's say that they know that their guys have roughly $50 in expenses a day. So they're going to pay that person instead. They're going to reduce the wage down to $150. They're going to pay that in taxable wage, and they're going to give the cleaning person a $50 reimbursement if they can substantiate the $50 in cleaning expenses, whatever those cleaning expenses are. And so this obviously is acceptable. This is, if this was the only thing that was happening, we'd be fine. Now, they do also know that there will be times where the person either has zero expenses, or maybe the location provides the cleaning supplies, or maybe they just have lost receipts or didn't keep the receipts intentionally or never got one. And so they really can't substantiate those expenses. So in this case, they're still going to pay the person the $150 in taxable wage, but because there's no substantiation of the expenses, they're not going to pay them any reimbursement. And notice the key distinction here between this and all of our other examples so far today. They're not increasing the wage. So the wage is not changing in this. They did what the IRS calls prospectively adjusting the wage beforehand, and they're not paying it back. The IRS rules in this case that this passes the business connection rule. This is an accountable plan because of those two exact characteristics. They prospectively adjusted the wage, and they did not pay back the difference to the employee. And these are direct quotes straight out of that regulation. And so we wanted you to see, okay, so if you wanted to do a per diem plan, and most of ours are set up this way, is you're going to have to prospectively adjust that wage, and you're going to have to leave it alone. You don't want it changing after the fact. And so that is sort of the fifth example that we're going to go over today. Now, we want to put this into practice. What does this mean to a trucking company? Well, here's the usual scenario that we see. Normally, when we come into a company and they're running a per diem program, and they say, hey, we want to know whether this is wage recharacterization or not. This is the usual scenario. Let's say we have a driver and he drives 500 miles, and the mileage rate, we're going to pay him 40 cents a mile, and we owe him $200 for those 500 miles. And as a company, we say, also, while the drivers are away from home, let's say we want to pay them $50. So that looks like this. But when a driver is near home, we obviously understand that we're not allowed to pay him per diem. So instead of paying him the $50 in per diem, we're going to just pay him the $200 straight wage and make it 100% taxable. This is this scenario we see by and far the most when we come into a carrier. They've gotten to the end of the pay period. They look and see whether the driver was out or not. And if they were out, they take $50 of his total compensation and they make him per diem. And if they weren't, then they just leave his wage alone and it's 100% taxable. When you look at it in this rubric and you compare this to our other examples, it's identical. I mean, this is classic wage recharacterization. You can see now, okay, this is exactly how we would set it up at HCH when we talked to a company that was doing this. These are the questions that we would ask them. And this highlighted red region is exactly what we would compare to the IRS examples. And we would say, well, if you were audited, IRS would tell you that you have a problem with wage recharacterization. They would rule that you were a non-accountable plan. You would pay back 15.3% on every dollar per diem that you paid. That's your FICA and the driver's FICA that you should have withheld. And you're going to get taxed with penalties and interest. And you could probably bet that the IRS is going to audit you for the remainder of the years that are under the open statute. And by the way, we recommend shutting your plan down. If you want to pay per diem, there are ways of doing it. So this brings us to a very important question, and a question that we get a lot at that juncture when we start talking to carriers and we explain to them that they're probably engaging in wage recharacterization. And that's, do these rules apply to the transportation industry? So I heard that there are some exceptions to the transportation industry, and maybe we could fit in one of those. And I would tell you, okay, there are exceptions to the transportation industry. However, those exceptions do not apply to wage recharacterization. And anyone that wanted to think about, okay, whether or not this would apply to us has a couple of things, a couple of thoughts that they need to run through. The first thing is that the transportation industry is quite broad. It's not just the trucking industry or even drivers. It includes planes, trains, trucks, barges, and buses. So if you're going to look at examples, and if you're going to look at case law, and if you're going to look at IRS memos, you need to cover all of these. So the transportation industry, as far as the industry exception and as far as wage recharacterization goes, has to deal with all 5 of these, not just trucks. And so all the plane cases out there, and there are many, apply it, as well as the ones dealing with drivers. The second thing I would think you need to realize is that because they started in Regulation 62, that the industry-specific rules actually began in that same regulation in Section D. We were dealing with other sections, but in Section D, they talk about the industry-specific rules. So you're going to have to deal with all of the case law examples, IRS memos, and revenue rulings and procedures since 1989, all of them. And so you don't have as much of a fixed window as you'd like. The third thing that I really would like to point out is we've gone over a couple of examples here, but there are many more examples, especially when you get into the planes and the other ways, these bus drivers and things like that, and case law, obviously, IRS memos. And so my initial reaction is, there are a lot of really good reasons statutorily why this applies to our industry, but the number one reason that I can point to is like, well, if it doesn't apply, why do we have all the cases, and why do we have all the IRS examples that seem to apply these rules to our industry? And that's a pretty hard question to rebuff. If none of these examples would make any sense, and none of these cases would make any sense, wage recharacterization cases would make any sense if they didn't apply to our industry. And so, if you don't take anything else out of the whole talk, maybe this is a really important point that, we really feel like these are going to apply. IRS certainly feels like they're going to apply. The courts are certainly applying the rules that way, and that's normally the way that we'll set up a plan. To start wrapping this up here, because we're getting close to the time that I promised. Remember, we have 5 basic requirements under section or Regulation 62. Business connection, substantiation, return of the excess, everything done within a reasonable period of time, and that is not abusive. And we've talked about just one today. That's wage recharacterization of just one of those requirements. So a requirement of a requirement, the business connection requirement. You still have a lot to do in your plan. You got to make sure you cover all these other bases as well. And even if you've covered all the other bases, you got to make sure you don't engage in wage recharacterization, or your plan will just simply be judged non-accountable. With that said, this has been really fast. There've been a lot of examples in a short amount of time, a lot of discussion of case law and IRS and revenue rulings. I just want to summarize real quick the important points of what we've learned today. The first is the most obvious one. You simply cannot adjust wage or per diem after the fact. If you're waiting to the end of the pay period to determine whether or not someone is out and then adjusting his wage and his per diem to meet those days out, that's classic wage recharacterization. That will instantly get you in trouble. Another important side of that we didn't talk about as much is you really are required to only pay those who will have expenses. And so you really have to start grouping your employees. If you have employees that do other things that require them, maybe don't require them to actually be away from home, you have to sort of separate the two worlds. You should adjust your wage prospectively. All of the plans that we set up adjust wage prospectively, regardless of how they're set up. And obviously with those last examples, you can't pay back the difference to the employee, or else it just looks like you're just trying to pay the employee a set amount. You don't really care whether they're out or not, and the IRS is going to see right through that. The courts are going to see right through that. With all that said, we want to have just a short 1-minute discussion of daily per diem versus cents per mile per diem. We want to be just open with everyone on the phone. We've set up and properly designed both of those plans. A daily per diem rate, currently $66 a day, or a cents per mile rate where we take some of their wage and we do this proper prospectively adjusting, and we calculate it, and we pay it as a cents per mile. Normally a carrier is going to make that decision on what to pay based on how the drivers are already being paid. If a carrier is already paying a driver cents per mile, the naturally easiest way to prospectively adjust that is with a cents per mile per diem program. In the same way with a daily rate. It's much more difficult to say, oh, I'm going to pay you a daily rate, a daily wage rate, and a per diem cents per mile rate, although those plans do exist. It's just harder to then prospectively adjust the wage and satisfy all the examples. So with that, I think I'm going to turn it back over to Dave just to go through a few quick points and maybe some question and answer at the end.
Okay. Thanks, Tommy. I know we went through a lot in a short period of time. There's just a lot of information when it comes to driver per diem and those regulations. And really, we wanted to kind of give some insight to carriers, currently running HCH per diem programs, and those who aren't as well, as to why we do things the way we do, to try to help understand why we set the programs up the way we do. And it all has to do with the case law, the regulations. Really, the IRS dictates how we run the program, and we're just kind of running in their bounds. And so hopefully this gave you a little information on how that works. As we mentioned, there's a lot more that pertains to per diem and how to run a compliant program. And in the future, we'll be hosting other webinars as well on other components of per diem, as well as some of our other services, including licensing, registration, titling, fuel tax, and some of our software programs, Permits Link and Titles Link, used to access documents. But if anybody has any questions in the meantime, or if you want to see our previous webinar on the do's and don'ts of driver per diem, that kind of gives a good broad overview of driver per diem programs in general and how they should be run, please feel free to contact me or Tommy. You'll see our contact information below. You can also visit our website there, hchta.com, has some information on our services and what we can do, other services as well as driver per diem programs. And
or if I'd just like to add, or if you have an idea about a webinar you would like for us to tackle on these, that's how we came up with this webinar. Feel free to submit that too.
Yeah. And with that, we'll give a minute see if there are any questions that anybody wants to ask directly through the webinar here. If not, again, you can always send an email to Tommy or I with our contact information below, or give us a call